Hi, welcome to Business 354. This is the PowerPoints with lecture notes. I'm basically trying to do the reverse classroom thing that Gerda Kitz and Rem Koistra have tried in their courses. And the idea here is that we want you to review the lectures outside of the classroom so you can do it whenever you want. And then in the classroom, we'll actually use that time to interact with one another and look at specific problems and that sort of thing. So this is the first one, and it's Business 354. So this is Intermediate Accounting, the second part. And so this first chapter that we're covering in this course is Chapter 13, where we're talking about non-financial and current liabilities. So we've learned a little bit about these in previous courses, but this course takes a lot more depth, takes a look at these issues in a lot more depth. So to begin with, let's quickly review the CPA Canada Handbook, which is the essentially the generally accepted accounting principles for Canada. There's a couple of major parts. The part one is the International Financial Reporting Standards, and of course that applies to public companies. And part two is accounting standards for private enterprises. That's called ASPE for short, and IFRS generally applies to all of the public companies. There's also a couple of other parts. Part three deals with nonprofit organizations, and part four deals with pension plans, and those aren't covered in this course, so you can safely ignore those for now. So both ASPE and IFRS were required for year ends beginning on or after 2011. So private enterprises is for ASPE. A private enterprise is one that hasn't issued or isn't in the process of issuing debt or equity instruments that are outstanding and traded on a public market. So if the security, all of the relevant debt and equity securities are owned by private holders and not on public markets, then ASPE can apply. Private enterprise doesn't hold assets for someone else, for a broad group of outsiders, as one of its primary businesses, so it doesn't have any significant external or public obligations. So that's kind of where ASPE applies. IFRS, of course, applies to everything else that does have debt or equity instruments or holds assets in a fiduciary capacity for someone else. Fiduciary means that they're holding it in trust for the person, so they are responsible for taking care of it on the behalf of someone else. Okay, so the relevant parts of the CPA handbook for purposes of the non-financial and current liabilities are as listed here. We're going to be talking about most of those. And so the section listed here is the section for ASPE, and the IAS stands for International Accounting Standards, and that refers to International Financial Reporting Standards. So that's basically just for reference, so you can look at back at that if you want to. So learning objectives for this chapter, we're going to be looking at non-financial and current liabilities, and it's from the perspective of a business, so that we're not talking about sort of personal liabilities, that sort of thing. We're going to distinguish financial liabilities from other liabilities. We've got a general definition for liabilities, and then we'll talk about the different treatment for financial liabilities and other non-financial liabilities. We'll talk about their measurement. We'll talk about what current liabilities are and why that's important. And we'll look at kinds of current liabilities that are fairly common for business. We'll look at some employee-related liabilities, so all of the deductions, payroll deductions, and vacation and maternity leave, all those sorts of things come up under employee-related liabilities. We'll talk about decommissioning and restoration obligations, and there's an allowance set up for this. And what might be the easiest example here in Alberta is for things like the tar sands, where there's an overburden of soil on top of the tar sands, and you basically have to clean that away in order to get down to the tar sands, which you mine. And then they use steam and a bunch of other technology to get the oil out of the tar sand. And then when they're done, they have to put it all back. And that's the decommissioning and restoration obligation. So basically, they have to put back the soil and then plant trees and make it all nice and return it to something close to the condition it was in before the tar sands started to be mined. Then we'll talk about the unearned revenues, and we've talked a little bit about those. And of course, you're all thinking unearned revenues, the classic example, WestJet tickets paid for in advance, right? So you all remember that from 253. And then we'll talk about guarantees, warranties. So when we sell a product and we promise to take care of the customer if something goes wrong with that product, that represents an obligation. So we're going to have to pay for the obligation in future periods, and of course we've sold it this period, so we have to match the future obligation with the revenues this period. And there's a few different categories there we're going to look at. There are some other customer program obligations that we look at, so those would be things like coupons or something that obligates us to do something for a customer, a contest or something like that. We have to recognize those liabilities if they're significant. We'll talk about contingencies and commitments, and talk about what that actually means, and talk about how we report that properly. And then we'll talk about analyzing liabilities. It's usually the concern there is whether you have enough financial assets to cover your current liabilities. So do you have more current assets than current liabilities? So we'll talk about a few common ratios there, and then we'll talk about differences between IFRS and ASPE as we go along, and kind of finish up with talking about what changes are being considered for the different accounting standards. So that's where we're going in the lecture. So Chapter 13 basically explains the principles regarding accounting and reporting for all kinds of common current liabilities and some non-financial liabilities. Non-financial liabilities would include unearned revenue or product warranties, any other customer obligations, asset retirement obligations. They're not financial liabilities, and we'll even though they're going to have to be paid in some kind of financial terms, we'll talk about what specifically refers to what the IFRS specifically refers to as financial liabilities, and it's a very specific definition. We also talk about contingencies and commitments and guarantees in this chapter, and those are another example of non-financial obligations. Excuse me. So we're using essentially, if you remember back to the list that we had a couple of slides ago, International Accounting Standard 37 refers to provisions, contingent liabilities, and contingent assets. The International Accounting Standards Board issued a new exposure draft in May 2015, so a couple of years ago now, and it was entitled A Conceptual Framework for Financial Reporting. And what they're trying to do there was provide clear definitions of assets and liabilities, and give more definition, more guidance in terms of interpreting the definitions. In 2010, there was an exposure draft of amendments to this section, International Accounting Standard IAS 37, and they suggested that we should remove the term contingent liabilities and replace it only with consideration of liabilities which had a non-contingent obligation. A non-contingent liability, a contingent liability is a liability that depends on something else. So it depends on the outcome of a common example is a lawsuit, so it depends on the determination of the court. The exposure draft suggested that uncertainty about the amounts of these contingent liabilities would be taken into account. Let's back up here. The exposure draft in 2010 suggested that uncertainty about the amounts payable would be taken into account in measuring the liability and disclosing them on the financial statements. But there's no question about whether the liability exists or doesn't exist. And so when we get to that part of the discussion, we'll see that one of the things we need to consider is the likelihood or the probability that a liability actually exists, that we actually do have an obligation as the company. So the general populace, the accountants that were out there apparently didn't really like the idea. So in July 2015, there was a staff paper issued, and it made it clear that the 2010 exposure draft was being considered basically a bust, that they were reconsidering the issues. So, with regard to current liabilities, the first volume of the textbook, which is what we talked about in Business 353, was all about the asset side of the balance sheet and the related income side, or the related accounts in the income statement. This volume of the textbook, volume 2, is looking at liabilities and basically the whole liability and equity side of the balance sheet and the related expenses and other income statement accounts that are related there. So the key issue for liabilities is it's going to take us cash in the future to pay for the liabilities. So either we're going to have to pay in cash or commit some other of our other assets to fulfill the obligation. So that represents something that's a future commitment. So we basically don't own all of our assets. We have committed some of those assets to other people. So what exactly is a liability? Well, a liability, as defined under both IFRS and ASPE, it has three essential characteristics. There's an obligation of the enterprise, as it says. It's from a past transaction, and the settlement is going to take the use of assets or provision of services or giving up of other economic benefits in the future. So if you've already given up the benefits, you no longer have a liability. If it's an obligation that's going to arise from a future transaction, it's not a liability. If it's not an obligation of the enterprise, but it's an obligation of the shareholder, for example, it doesn't meet the definition. So think when you see definitions of things in accounting standards, think about what it would be to not meet that definition. What kinds of items would fail to meet that definition, and it kind of clears up a little bit what exactly the definition is saying. So the current definition talks about a duty or responsibility that the firm has to others. It also talks about the entity doesn't have any way of avoiding the obligation. If they can avoid the obligation, then obviously it's not an obligation. And any transaction or other event creating the obligation has already occurred. So it's a past creation of the obligation. And excuse me, this is similar to the proposed definition that was listed in the conceptual framework that we mentioned just a second ago. So a key term that we often see is a constructive obligation. That doesn't mean that it's an obligation related to building something. Constructive, there is use of the term construed. So it's construed to be an obligation if it arises when past or present practice shows the entity acknowledges a potential economic burden. So it's construed to be an obligation. It's a constructive obligation. So when you see that term, it's construed because of the nature of the case. Even though there's not a specific contract or a specific document that says that they have that obligation, if the circumstances show that it is an obligation, then it can be construed as an obligation, and we refer to that as a constructive obligation. Now, one key distinction that we need to make with regard to liabilities is a distinction between financial liabilities and those that are not financial in nature. So financial liabilities are contractual obligations to deliver cash or other financial assets to another entity, or to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable to the entity. This is very similar to the definition that we saw in last class with regard to financial assets, appropriately adjusted for the idea of financial assets as opposed to financial liabilities, but it's the same idea, that it's actually going to require a cash obligation. So it's cash or other financial assets have to be given up, or an exchange at a potentially unfavorable outcome to our firm. So, for example, an unearned revenue would not be a financial liability because it doesn't require the delivery of cash or any other financial asset. It requires the delivery of a service or a product in the future. Legislated liabilities such as income taxes payable are not created by a contract, so they don't qualify as financial liabilities either because it requires a contractual obligation. Measurement issues. Financial liabilities are initially measured at fair value, And subsequently, they're measured at amortized cost. So whatever the cost of the asset was, we amortize it in over the life of the asset or using some sort of amortization methodology. Short-term financial liabilities, such as accounts payable, are generally accounted for at their maturity value because there's not a lot of time that passes, so there's not a significant amount of discount. So the amount of difference between the present value of the obligation and the obligation when we actually have to pay it is not a material amount. So if you've taken 370, or if you are taking 370, one of the things that you're going to talk about there is present value calculations. And that's what we're talking about here, because there's not a significant amount of time. There's not a significant difference in the value of short-term financial liabilities. Non-financial liabilities under ASPE are generally measured at the fair value of the goods or services to be delivered in the future. And under IFRS, non-financial liabilities are measured initially and then at each subsequent reporting date, which is usually every subsequent balance sheet date, at the best estimate of the amount that the entity would have to pay at the statement of financial position date to settle a present obligation. So if they can determine how much they would have to put into a bank account now to fulfill their obligation in the future, that would essentially be the present value in most cases, and so that would represent the amount that they would have to fulfill in the future. On the balance sheet, or the statement of financial position, liabilities are classified as current or long-term liabilities, current or non-current. Non-current and long-term are essentially synonymous words, or synonymous terms. Current liabilities are those obligations whose liquidation is reasonably expected to require use of existing resources classified as current assets. So if it's going to be paid out of current assets, it's a current liability. Or it could require the creation of other current liabilities, in which case the fact that it's going to be a future current liability means that it's probably a current liability today. So that relationship between different parts of the working capital, current liabilities versus current assets, that's an important factor in determining whether a company is actually able to pay its bills as they become due. So it's an important part of the analysis of any company's condition. We're going to talk about an analysis a little bit later. But the key, the obligation part, the cost or the future, the bad news part is the current liabilities. So we would recognize a current liability if the liability is going to be expected to be settled in the entity's normal operating cycle, which is usually a year, or if it's held primarily for trading, so it's something like an obligation arising under a derivative, like stock option, that sort of thing, or if it's due within 12 months from the end of the reporting period, so within 12 months would be within the next year, or if the entity doesn't have an unconditional right to defer its settlement for at least another 12 months after the statement of financial position date. So if it can't actually defer the obligation until the year after, next year, we would recognize it as current liability. ASPE has a little bit less specific definition, but the same kind of things would apply. So you could apply the IFRS definition to ASPE. In general, we talk about a liability which is going to be paid within the next year as a current liability. So what kinds of current liabilities might you see? Well, bank indebtedness is one of them. A lot of companies set up what we call a line of credit or a revolving loan. And the line of credit or revolving debt allows you to borrow when you need to and pay back when you can. And so the cash position of a company as reflected in its bank account on the asset side and the associated line of credit and revolving debt are kind of part of the whole financing of the business. So instead of having to negotiate a new loan every time the company needs funds, it generally enters into an agreement with the bank to make multiple borrowings up to the negotiated limit, as it says here. The company would draw on the funds as needed and would pay them back as they have extra funds. And there's usually not a required installment loan payment that's required. So they wouldn't have a pre-negotiated payment in mind. There may be a minimum amount of payment, a certain percentage of the balance might be required, but in general, line of credit is a revolving loan, or it's a loan that can be paid when you have the cash to pay it. And the key things for financial reporting: the amount borrowed should be reported on the balance sheet, so the amount outstanding at the end of the year. And if there are any restrictions on the cash account or other funds for the firm, then any of those restrictions would have to be disclosed as a note to the financial statements. So in general, you disclose the obligation as a liability and any reductions in your ability to use the cash as a note. So those restrictions need to have note disclosure. Okay, so moving along, accounts payable. We generally talk about accounts payable as trade payables. And the idea here is that they represent obligations owed to others for either goods or supplies or services which were purchased on what we call open accounts. So they have a certain credit limit that they can use, and we send them stuff when they order it, and they have promised in general to pay when the account payable is due. So generally the obligation arises when title is passed, and you guys remember the discussion of FOB, whether it's free on board at the destination or free on board at the shipping point. So we talked about that title passing as part of our discussion of revenue recognition in the 353 course. So essentially for the revenue to be recognized, you had to have the 3 C's. You had to have it had to be calculable, it had to be measurable, it had to be collectible, and it had to be completed. When we're talking about accounts payable, we're talking about our side of the transaction, so collectability is not an issue. Completion, when we have title to the asset, that's essentially completion from our perspective. And we are usually paying a fixed amount, so there's usually not a whole lot of issues with regard to measurement. But because we're talking about the liability side, the measurement issues aren't as significant, because if we record more liability, that would tend to make our balance sheet be more conservative or more prudent in the terms of international financial reporting standards. So in general, we're not worried about overstating accounts payable, we're worried about understating accounts payable. So measurement usually isn't a significant issue. We would record the obligation at whatever it is that we're paying. Now, we do have some situations where we have a liability which isn't easily measurable, and we'll talk about that when we get to the contingencies part of this chapter at the end. So things that you need to remember about accounts payable. The obligations, trade payables, should be recorded to recognize the time when title passes or when you actually receive the goods. And the end of the accounting period is when auditors actually do what we call a search for under-recorded liabilities. So we look at payments made after the end of the year, after the financial statement date, and we determine whether or not the liability has been properly recorded in the correct period. So we look at payments, we look at outstanding invoices received from our vendors, and the key idea there is that we're concerned about transactions close to the end of the accounting period being recorded in the correct period. So we need to make sure that if we receive the goods, if we received inventory, that we record the liability to pay for it in the period in which we've received the inventory. So we can't have the inventory increasing our current assets and not record the liability against it. So accounts payable, we have similar credit terms to what we had on the revenue side. So the 2% 10 net 30 terms refers to the fact that you get a 2% discount for paying early, and the entire amount is due at the end of 30 days. And in general, 30 to 60 days is the normal payables period. Okay, so notes payable. Notes payable, remember when we see the term notes, we're basically talking about an IOU. So it's where one company has written a specific contract to cover an obligation to the other company. Accounts payable is what we talked about. We mentioned the term open account. We've kind of agreed to offer them credit up to a certain amount with the expectation that they will actually pay. So there's kind of an implicit contract there. With notes payable, there's an actual contract that obligates one company to pay the other one. So a notes payable is essentially an IOU. So it's a written promise to pay a certain sum of money on a specified future date. It could arise from sales or financing or other transactions. Lots of different ways that we can generate a notes payable. It can be used to replace accounts payable. If we can't pay our accounts payable or we don't want to, we can issue a note payable in settlement and then change the terms of the contract with us, or change the terms of the accounts payable with a specific contract that talks about changing the terms. So notes can be either short-term or long-term. We've talked about that on the receivable side. It's also true on the payable side. Notes payable can be set up as interest-bearing, in which they specifically say how much interest is going to be paid, or they can represent zero interest, in which case they just tell us how much we have to pay at some time in the future. And so we have to infer from the terms of our normal borrowing costs or the terms of the transaction what the amount of interest is. And that gets a little bit tricky. And here you have to kind of rely on your Business 370 skills as well as some understanding of present values. But we'll talk about that as there's a couple examples that we'll go through in the PowerPoints here. Short-term notes payable result from borrowing funds with the term specified in the transaction. So notes payable results in interest expense, and the reason for that is that unlike accounts payable, which has a very short time frame, notes can be a year or longer, and so short-term notes may have an interest effect as well. It may not be material with short-term notes, in which case you can kind of wave your hands and make it go away. But in general, longer-term notes would have to have an interest expense recognized. So we need to make sure that we account for that properly, because we've already made the transaction to purchase whatever asset is. Any future payment of a note for a different amount, the difference is a financing transaction. It's not a purchase transaction, so it shouldn't be recorded as part of the cost of inventory, for example. So here we have an example. Let's say that Landscape Corporation borrowed $100,000 and signed a 4-month 12% note on March 1st. So 4-month 12% note would mean that if it's 4 months, that's a third of the year. So that's about a 4% interest amount. And so we need to record the journal entries for the signing of the note, recording the obligation, the accrual at the end of the year. So June 30th is the year-end amount. And so we signed it in March, so March, April, May. We've got 3 months gone. No, that's not right. March 1st, April 1st, May 1st, June 1st. There shouldn't be any interest accrued at the end of the year. I guess we're assuming that we haven't paid it at the end of the year. So interest accrual at June 30th, we have all of the interest. And then note repayment would presumably happen shortly after the end of the year for a 4-month note. So the journal entries. March 1st, we would get cash, and we would record the notes payable, so debit cash, credit notes payable. And then on June 30th, after 4 months have passed, we would record the interest expense for the entire 4-month period. So it would be the obligation of $100,000 times 12% times 4 months out of 12. So that's $4,000. And then on July the 1st, presumably the next day, we actually pay the note. The notes payable goes away. The interest payable goes away. We set up the interest payable the day before so that we had the obligation recorded at the end of the balance sheet correctly. So we did owe $4,000 at the end of the year. We need to make sure we record that in the balance sheet on June 30th. And then the amount of cash we paid is $104,000. So that's a credit to cash. So that's an example where there was an interest-bearing note. What if we had a non-interest-bearing note or a zero interest-bearing note? Well, if we had the same, essentially the same terms, the difference is that the payment is going to be made in the future, and so the payment amount is noted in the notes payable. It's actually in the contract, and we have to infer from the terms of the contract how much the interest expense would be, because there's no specific interest expense designated in the contract. So we need to figure out the amount. So if we move along here, let's imagine that Landscape issues a 100,000 4-month zero interest-bearing note on March the 1st. And the present value of the note is 96,154. And so if you do the math, you can determine that that's a 4% interest rate, but it's, well, 4% over the 4 months. So it's the same interest rate as we had before, but it doesn't actually tell you that in the contract anywhere. So 96,154 is the present value of the obligation. 4 months from now, we're going to pay $100,000. So again, we have to prepare the journal entries for the same 3 crucial dates that we had before. So on March 1st, we get cash of 96,154, and we have a note payable for 96,154. On June 30th, the end of the note's term, the note payable, it goes up to $100,000. Excuse me. So 96,154 plus 3846 adds up to $100,000. So the difference between the amount of the notes payable, 96,154, and the amount that we owe of $100,000 at the end of the 4-month period is interest expense. So the June 30th journal entry reflects the fact that we owe $3,846 of interest plus $96,154 for the note. So then when we pay the next day, we pay $100,000 of cash and we reduce the notes payable. And so the notes payable is gone. So we borrowed $96,154 and had to pay $3,846 of interest for the total amount paid. So key things, if there's interest specified in the note, so you know how much you're borrowing, but your future payment will bear interest. The interest expense follows the interest-bearing note example. And if you don't have an idea of the interest rate, but you know how much cash you're getting today and how much cash you're going to have to pay in the future, that's the case of a zero interest-bearing note. And the difference between the two is financing cost or interest cost. One of the things that we talked about very briefly in 253 was the current portion of long-term debt. And so the idea here is that the currently maturing portion of the long-term debt, like what we're going to have to pay within the next year, should be classified as a current liability. So if you've got a series of payments and there's a principal obligation and an interest let's try that again. You've got a series of payments that you're going to be making the next year. So for example, a mortgage, and you know what the amount of the interest is for each payment that you're making. So you pay interest on your previous balance, and then the rest of the payment goes against the principal of the mortgage. That principal portion, if you added that up for all the payments within the next year, that would be your current obligation. So whatever it is that you're paying off in terms of the principal by whatever agreement is specified. So your mortgage payments, split them into principal and interest. The principal portion is what gets recorded as the current maturity of the long-term debt. So whatever is going to be paid within the next 12 months. A couple of key points which are raised in the slide here. If there's a part of the long-term debt which is going to be paid by something other than current assets, so if you're going to exchange a long-term asset, so if as part of your mortgage you're actually going to give them some real estate property, that would not be classified as a current liability because you're going to be paying it out of current or out of long-term assets, not out of current assets. So if you're not going to be paying it out of your cash or out of your collection of accounts receivable or inventory, then you wouldn't record it as a current liability. Now remember, our concern is that we need to make sure that current liabilities include everything, so it would actually have to be by contract, as it points out here. It has to be by contract to be retired by something other than current assets. Liabilities which are due on demand would be recorded as a current liability, and there's a little bit of difference between the treatment under ASPE and the treatment under IFRS for liabilities due on demand. So these are commonly called demand loans, and so the bank has the right to call a loan at any time. That's a demand loan. So is classified as current even if the debt agreement has a payment schedule over several years, because they have the other party to the transaction has the right to call it at their discretion. So you have to pay it if they ask for payment. So liabilities that become callable by the creditor because of, for example, a violation of a debt covenant would be classified as current because they have an obligation to pay it immediately, even if it was previously classified as long-term debt. Under IFRS, that classification would hold even if the lender agrees between the balance sheet date and the date of the financial statements that it won't demand repayment. At the time of the balance sheet, it was an obligation because of the debt covenant violation. So that would be an example of a case where you would actually have a current liability. Even though you've renegotiated terms after the balance sheet date, you can't change the nature of the obligation at the balance sheet date by a later contract. So that's because the lender, not the entity, is the one holding the unconditional right to defer the payment beyond 12 months. It's not our company that gets to choose when they pay. It's the other company that determines when they're going to demand payment. Under ASPE, it's slightly differently. It's treated slightly differently. The liability is reclassified as current unless the creditor waives the covenant requirements or the violation has been cured within the grace period, so it's actually been paid or been settled some other way, or if it's likely that the company will not violate the covenant requirements within a year of the statement of financial position date, then under ASPE, they don't record as a current liability. Now, a similar situation to a demand loan would be short-term debt which is expected to be refinanced over the next year. So do we treat that as current or do we treat that as a long-term obligation? IFRS here has more stringent rules than ASPE. Under IFRS, you can't record it as a long-term obligation unless the company has both the intent and the right under the contract at its discretion, not at the other party's discretion, to refinance with long-term debt. So if it has that right under the contract, so it has the right to replace it with a long-term loan, and they intend to do that, and they've expressed that intent to, well, the auditor, or to in a way that's it communicates that intent to the other party, then we could treat the debt as long-term. If not, if it doesn't meet both of those requirements at the date of the financial the balance sheet date, then you can't do that. Under ASPE, if you actually settle it between the financial statement date and the date that the financial statements are issued, you can actually treat the debt as being long-term debt. So you can actually remove it from your current liabilities under ASPE. Now there's an illustration in the textbook you might want to take a look at, illustration 13-2, and it talks about an example of the short-term debt paid off under these conditions. So under IFRS, if the debt is due within 12 months from the reporting date, it's classified as a current liability, even if a long-term financing has been completed before the financial statements are released. Under ASPE, that would allow you to restate them. The only exception to that rule is if at the balance sheet date, the entity has the right under the existing agreement to roll it over into a long-term debt. Dividends payable. Dividends payable result from the shareholders of the firm receiving a payment as a return on their investment in the company. And we know from previous discussions in previous courses that cash dividends are not a liability until they're declared by the board of directors. So when the board of directors declares the dividend it is at that point that it becomes a current liability and the company is obligated to pay it. They don't have to pay any dividends if they don't have the cash to do so. So if the board of directors doesn't declare it, there's no liability arising. Now, cash dividends are classified as current liabilities because they're usually obligated to be paid within a short period of time. So during the period subsequent to declaration, prior to payment, they are a current liability, and it's a binding obligation when it's declared by the board of directors. Now, stock dividends are a little different. Stock dividends are not a liability because there's no payment there's no distribution of assets required. So stock dividends are when the company basically issues new share certificates and issues them to all shareholders in their proportional ownership. So there's no change in in the amount of the contribution that they've made. So it's still the same number. It's just the number of shares goes up. So a stock dividend, as it says on the slide, doesn't meet the definition of a liability because there's no future outlay of either assets or services to fulfill that obligation. We've talked a little bit about preferred dividends in arrears in previous courses, and we talk about it in some degree in the finance course as well. But preferred dividends can be either cumulative or non-cumulative. Cumulative means that if we don't pay them their dividend this year, we can't pay the common shareholders any dividends next year until we paid both the dividends which haven't been paid this year and their entitlement to dividends next year. So preferred dividends, which are cumulative, accumulate over time. Once again, it's not a liability until it's actually declared, but the legal contract related to preferred shares says that before you can pay your common shareholders anything, you have to pay the preferred dividends. So if you were to declare a dividend to the common shareholders, it would imply a preferred dividend obligation as well, because the preferred dividend obligation has priority over the common share payment. So it's not a liability until it's declared, but if you declare dividends to your common shareholders, there's an implication that you have to prepare a dividend for the preferred shareholders as well. Rents and royalties. So these are contractual agreements covering rent or royalty payments, and they're conditional on the amount of revenues earned. For example, the Alberta government gets royalties on oil which is extracted from the ground in Alberta. So if you're using somebody else's assets and you get some benefit from that, the amount of the royalty would depend on the amount of the revenue earned. Rent also could be dependent on the quantity of the product that was produced or extracted from that royalty. So that would be an example of the oil and gas obligation. If they produce something from their lease, their oil and gas lease, they have to pay the government a royalty. So that royalty payable depends on the amount of revenues or the amount of oil that's extracted from the leased property. So for each additional unit of product that's produced or extracted, there's an additional obligation which we have to record as a current liability. In most cases, it would be current because you have to pay it within the next year. And so that would also include franchisees and tenants based on the terms of the contract. And so that obligation, you'd have to calculate the amount of franchise fees owed at the end of the year, usually a percentage of sales or some other specified term in the franchise agreement. That obligation would be recorded at the end of the year at the balance sheet date. And tenants in shopping centers often have to pay based on the amount of sales. They pay often there's a straight monthly amount, and then there's an additional rent that's paid on the sales volume. So whatever the obligation is arising from those past transactions, that meets the obligation of the definition of a liability because it's a past transaction to be settled in the future, and it's an obligation which is not beyond. It's an obligation that can't be gotten away from. Okay, customer advances and deposits. So these are cases when the customer pays us in advance, and it's a kind of deferred revenue, or it's kind of unearned revenue amount. So if they pay deposits for us to do something for them, then that could be current or non-current, depending on whether the obligation is going to be completed within the next 12 months. So when returnable deposits or customer advances are received from customers, or they could be from other groups such as employees, we record a liability which is related to the fact that we have an obligation to do something in the future. So either we have to give them their money back, or we have to give them the service or the product that they've paid us for. Taxes. Two things certain in life: death and taxes, according to I believe it was Mark Twain who said that. But taxes payable in Canada, many many provinces have provincial sales tax, and so if the business has to collect their provincial sales tax from their customers and then remit it to the government, there's an obligation created because they're essentially holding the money in trust for the government. So they charge the customer, collect it from the customer, and then remit it to the tax authority later. Sales tax is an example of such a tax, and in Alberta we haven't had a provincial sales tax, but it looks like we're going to get one. So the idea of sales tax is that the vendor collects the tax and then pays it forward. Now GST has been applied in Alberta for a long time, so that's an example of a sales tax. And current tax laws say that the business has to collect the taxes and then remit those collections from the customers to the government, and so that represents a current liability obligation. So sales tax, when you make a sale, you basically collect both the sales revenue, which is goes into your income statement, and the tax on those sales would be set up as a sales tax payable. You would receive the cash or the accounts receivable for both of them, and then when you collected the cash, you would actually remit it to the government. So you would set up your debit accounts receivable for the total amount of the sale plus the tax, and you would credit sales for the amount of revenue, and the sales tax payable liability account would be credited for the related sales tax amount. GST, goods and services tax. Most businesses in Canada have to submit the goods and services tax. If you have less than $35,000 in revenue, you don't have to. You don't have to charge your customer. But if you do, if you have more than $35,000 of revenue, then you have to get a GST number, a business number from CRA, and you have to tell your customers what your business number is when you charge them GST. And once again, you're charging that GST on behalf of the government, and you're holding it in trust, and then you pay it with regard to the CRA schedule. So some businesses have to pay quarterly, some businesses have to pay monthly, some businesses pay on an annual basis, depending on the amount, the volume of revenue. So there's a couple of things that can happen. GST is a value-added tax, so that means that when you buy something, you get a credit for the GST that you pay, but when you sell something to a customer, presumably mark it up, and the difference between the two is the GST that you have to pay. So you get a credit for the GST you've paid, and that's the GST recoverable that it talks about in the slide. The GST payable is the amount that you owe based on your sales. The GST recoverable is the input tax credits that you have on everything you've purchased. In general, if you're making money as a business, that means that your GST would be a liability because your GST payable on revenue would be higher than the input tax credits on what you've purchased. So in general, it would be a current liability. We don't have a harmonized sales tax in Alberta, but on a harmonized sales tax applies in some provinces. So the net amount of GST payable versus GST recoverable, and they are offset by Canada Revenue Agency, so you are allowed to offset them. And because that's actually part of the agreement that you have with the CRA, you can offset them. You don't have to show the current liability for the credit balance and the current asset for the debit balance. You can offset the two, and so that's the amount that's shown on the balance sheet, the net obligation. If HST applies, the rates are higher, but it's essentially the same approach. Income taxes payable. Now, corporations pay federal and provincial income tax, and so it's based on the Income Tax Act, and so you calculate the amount of tax you owe based on your income and the specific terms of your income. Depends on whether you've got a small business deduction or manufacturing processing. There's a bunch of things that change the tax rate that applies to different corporations. But once again, you're viewed as having collected that on behalf of the government, and so you have an obligation to pay them based on the income that you've earned. And at the end of the year, though, you're not certain exactly the amount of income that you have to pay, so it's quite common that you would estimate the amount of income tax payable at the end of the year, as it points out here. And so the corporation should estimate and record the amount of the income tax liability as computed according to its income tax return. And then Chapter 18 will talk a little bit more about the complexities of future income taxes and the differences between the accounting rules and the tax rules. Gives rise to some interesting tax benefits and interesting tax obligations. Like you prepay some taxes and you get a benefit. You basically can defer some taxes, and we'll talk about that in Chapter 18. Employee-related liabilities. Now these include when you pay an employee, if they make over a certain minimum amount, you have to pay Canada Pension Plan obligations, employment insurance obligations, and you have to collect employment taxes from your employees and submit all of those as a remission to the government as well. Now, when you're taking the taxes, there's no matching obligation for the corporation, but if you have employees, you have to match the CPP, and for the EI deductions, you actually have to pay 1.4 times the amount that the employee pays for their employment insurance obligation. So, of course, that results in a current liability. So that would include payroll deductions that are listed here. Of course, you have salaries and wages, which you have to record at the end of the period. If there's a cutoff date, which falls after the end of the period, you'd have to calculate the amount of employee salaries and wages which were payable at the end of the year. You have to record the amount of payroll deductions. There are short-term compensated absences, things like vacation or maternity leave, for which you have to record the expense and record the obligation to pay in the future. There may be other profit-sharing bonuses, other things which you're obligated to pay to your employees as part of the contract that you have with them as well. So we'll start by talking about payroll deductions. Payroll deductions refers to Canada Pension Plan obligations. Of course, in Quebec, they do things differently. So the Quebec Pension Plan obligations are separate from the CPP. And employment insurance, you have to pay employment insurance if you earn over a certain minimum amount. And then the income tax withholding for both federal and provincial, at least in Alberta, it's both federal and provincial. Once again, in Quebec, the rules are slightly different. But this isn't a tax course, so we'll ignore that. But the fact that you have to remit these obligations to the government in the future means that you have a current liability for them. There may be other discretionary deductions, such as health insurance or union dues that you have to collect and then remit to the other, either the insurance company or the union, as the case may be. Those also would result in a current liability to remit them to the other entity as well. So here's an example. Assume we've got a weekly payroll of $10,000. It's subject to Canada Pension Plan at 4.95%, employment insurance at 1.88%, and they also have, they check the schedule, they check the table, and it says that you have to withhold $1,320 for income tax, and then there are union dues of $88. So we have to do two entries, the first for the wages and the second for the payroll taxes, and so here are those entries. The first entry records wages and salaries of $10,000. That's the total amount. And then it allocates the obligations. We're going to pay cash of $79.09 to our employee. We're going to pay $88 of union dues to the union on behalf of the employee. We're going to pay $188, $495, and $1,320 all to the government because all of these payroll deduction obligations are collected on their behalf. So those are the employee portion. So that's what we're paying on behalf of the employee. There's also an obligation that we have as an employer to pay a matching amount of CPP. So CPP is 495 up here. It's 495 down here. So we pay basically almost $1,000, $990 in total, half of which is the employer and half of which is employee obligation. EI premiums, we as the employer are required to commit 1.4 times the premium that the employee pays. So that's $263.20. So when we write a check to the government, we'll add up all of the employee portion and the employer portion, and we'll have to write a check to the government for that obligation in the future. So there's an employee portion and employer portion, and we have to account for both of those. Okay, moving along, short-term compensated absences. These would include things like vacation or illness or maternity, paternity, holidays, anything where we're paying the employee for time in which they're not actually working for us. So those are compensated absences. They have what we call vested rights when we have an obligation to make the payment to that employee. So even if they no longer work for us, if we have to pay them those obligations, we refer to vesting rights. So things like post-retirement health benefits or pension benefits, those are it's a key component of those considerations to determine when the vesting actually happens. So when do you actually have the right to collect it, even if you're no longer working for the company? Accumulated rights are slightly different. Those are rights that can be carried forward to future periods if they're not used this period. So that would include vacation, statutory holidays. So accumulating is rights that they've earned because of their employee service in the past. So they've got a certain vacation obligation. If they're working on a statutory holiday, if they're given a day off in lieu, that's an example of an accumulating benefit for statutory holidays. And so this expense and the related liability have to be recognized as those rights accrue to the employee, as they're earned by the employees. Non-accumulating rights are things that happen as a result of some kind of obligating event. And those would include things like disability, sickness benefits, parental, paternity leave, maternity leave, those sorts of things. Now, accumulated rights could be rights that are not vested. But if accumulated rights are not vested but can be carried forward to future periods, we would record them as obligations this period, because the event that the employee leaves the company, that event is something that's happening in the future, and so it's not doesn't allow us to reduce our liability at the balance sheet date. So non-accumulating rights are the ones which have been triggered by a particular obligating event, and so we don't actually have a liability until the obligating event happens. Either the disability occurs, or the sickness occurs, or the baby arrives. Those sorts of things are the obligating event in question. And so you would estimate your future amount of payment. And so whatever the terms of the contract are, sometimes paternity or maternity leave has a reduced amount of payment. And so the estimate of the obligation is based on the pay that actually applies in that situation, which is often the current rate of pay. But it's possible that you could even get a raise during the time that you're away on maternity leave. My daughter-in-law actually, during her maternity leave, was given a raise and actually has a higher rate of pay when she gets back, but it's not effective until she actually gets back to working. So they presumably had used the current rate of pay for her situation. Okay, a couple of other things we should briefly talk about. The expense and related liability for compensated absences should be recognized in the year in which they're earned by the employee. So the key term there is earned. Whoops, I didn't take you back to where I wanted to go here. Let's go back to where we were. And so whenever we can come up with a reasonable estimate of the amount that we're going to pay out in the future, we would record them at the balance sheet date, because we've already received the benefit of them working for us. Determine the cost of compensated absences. Companies are more likely to use the current wage rate than a future rate. There's usually not a material difference between the two. Future rate would be less certain, even though we may be settling a union contract at a higher rate, so there may be an increase in the pay rate. At the time, we don't want to commit to that. There's a couple of reasons. We don't want to promise a payment, a higher rate of pay to our union employees until we've actually negotiated and settled the amount. So we don't want to use that future rate and then sort of make it a self-fulfilling prophecy that the rate will be higher in the future. We talked about post-retirement health benefits. We'll talk about those in Chapter 19, but that's an example of a benefit which is a vested right, which will continue to be an obligation of the company even after the employee no longer works for the firm. Okay, AROs, asset retirement obligations or site restoration obligations. The idea here is like the overburden on the oil sands. You have to put it back and make it all look nice and pretty and serene and natural. You put it back in the condition in which it was before you mined all the oil sands. So some examples for that would be mining, oil drilling. So in those situations, you've got a long-lived asset, and the long-lived asset is going to be used for the production period. And then at the time of the retirement of those assets, you have an additional obligation to properly, restore the site. If you've got an oil, a gas station on the corner, you may have an obligation to actually clean up the gas tank that's under the ground, and a lot of people end up buying gas stations and find out that wasn't actually done, and so there's a huge future obligation. Anyway, you're supposed to take care of that in your accounting records before it actually happens. So a company must recognize an asset retirement obligation, ARO, because it's an existing legal obligation, and you have to do it if you perform certain kinds of activity. You're required to restore the land to the condition specified in your agreement. And so you have an existing legal obligation associated with the retirement of that long-lived asset, and so it's because you acquired or constructed or developed or operated the long-lived asset in the period, and so you get the benefit of producing tar sands oil. Then the matching of the future costs of restoring that obligation has to be matched to the revenue that you're earning from producing from that asset now. So we need to estimate, once again, we need to estimate the future obligation, and so we need to record the expense and the related liability at the time that at the period in which the obligation was incurred. So the obligation needs to be recognized when incurred. Some examples would be decommissioning nuclear facilities, oil and gas properties, mining facilities, other landfills. So if you've got, well, I guess a private landfill, apparently there's one south of town where you can dump stuff and it actually isn't run by the city. But if you've got one of those, then you have to make sure that you take care of whatever future environmental issues relate to that landfill, and that would be an example of an ARO. Now, once again, we talk about an obligating event, the completion of either your lease or your determination to mine the underlying resource. Those sorts of things could be the existing obligation. So there is some event that happens which puts an end to the production and it gives you or requires the obligation of completing the restoration, and it's usually written into the contract or the lease term. So there is an existing legal obligation. Under the handbook ASPE, section 3110, an ARO is initially measured at the best estimate of the expenditure required to settle the present obligation at the reporting date. So whatever you would pay somebody now in order to have them promise to do it in the future. Whereas IFRS refers to constructive obligations, and remember, once again, that refers to the fact that there's a construed obligation, even if it's not specifically listed in, like the terms are not specific in the legal document. There is a constructive obligation that any sort of moral obligation or obligation which is understood even though it's not part of the legal obligations would have to be recorded under IFRS. ASPE is basically looking at the letter of the law because it's a less stringent set of accounting standards. So the estimated costs of the ARO are included in the carrying amount of the relatively long, the related long-term asset. So the oil, the oil and gas platform or the mining facility, whatever that might be, and it's recorded in the same way as the liability. So you would record a reduction or an increase in the cost of the asset and an increase in the related obligation. So the asset retirement cost is recorded as part of the related asset because those costs are part of the cost of operating the asset. And so whatever the asset is, a mine or a drilling platform, nuclear power plant, should be increased and should not be recorded as a separate account. It's part of the cost of the asset. And it's going to be amortized to expense over the related asset's useful life. So whatever depreciation techniques you're using for the rest of the asset, you would use that same depreciation schedule for the ARO. And the liability is measured on a discounted basis, so it's represented the fact that you're going to have to pay sometime in the future. So you would calculate the present value of that future liability. And so as you get closer and closer to the date when you actually have to pay the liability, you're essentially paying interest because the future obligation is getting closer and closer. So we call that the accretion of the discount. And it needs to be recorded as an accretion expense. In ASPE, it can be recorded as an operating cost, or under IFRS, it's specifically treated as a borrowing cost or a financing cost. The fact that you are getting closer and closer to the date in which we have to actually pay the cash means that we're increasing the amount of the obligation because the interest cost is being capitalized as part of the liability. Any subsequent changes in the asset retirement obligation due to the production would be added to the asset cost under ASPE, and it would be inventoried as part of the production of whatever it is we're producing, whether it's energy or oil and gas or whatever. It would be recorded as part of the cost of the inventory under IFRS. Now, most AROs are long-term in nature, and so they wouldn't be part of current liabilities, so they're kind of outside the scope of this particular chapter. But there is a portion of the current liabilities depending on the interest amount. So the interest, the fact that the interest gets recorded on a short-term basis, the interest expense is essentially a current liability in that sense. So that's kind of why it shows up here. So we record the interest expense based on the discount rate which we use to calculate the present value, and that would usually be whatever our normal cost of capital would be for similar kinds of terms, similar kinds of projects. So under IFRS, it's recorded as interest expense. Under ASPE, it's recorded as accretion expense. Once again, if the ARO increases, the cost of the asset, the cost of the increase is added to the cost of the asset. Under ASPE, it can be inventoried as part of the cost of the inventory that we're producing under IFRS. Now here's an example. So we have an oil platform which is erected on January the 1st, 2017. It's going to have to be dismantled after 5 years, so we've got 5 years of production rights. The cost is going to be $1 million, and 80% of that value is related to the asset acquisition. We have a discount rate of 10%, which is our borrowing cost, whatever that might be. So that means the present value of the dismantling cost is $620,920. And in 2017, there's an increase in the ARO based on the production of oil. So we have an additional cost of $136,602. Then January the 10th, 2022, the platform is actually dismantled for a little bit less than $1 million. And so what are the journal entries? What do they look like? Well, At the time that we recognized the ARO, when we first put the drilling platform into use, we would record the present value of 496,736, which is 620,920. The future obligation times 80%, 496,736. Let's go bounce back up here. 80% is the present value of the dismantle cost is 620,920. 80% is due to the asset. There's an additional 20% dismantling costs which are related to something other than the asset. So only the 620,000 times 80% would be recorded as an increase in the asset value. And okay, so back here. So 80%, 496,736 is the present value of 80% of the obligation based on the drilling platform itself. Then at the end of the first year, you record amortization expense. The 496 gets divided over the 5-year life of the platform. So 99,347 is the straight line depreciation amount. And there's no salvage value related to that. Then December 31st, 2017, at the end of the year, you would record the fact that your 496,736 had gone up by 10% because you're 1 year closer to having to pay that money. So 496,736 times 10% is an interest obligation of 49,674, recorded as financing cost, interest expense for IFRS, recorded as an accretion expense as part of operating expenses for ASPE. And then next year, of course, is going to be 496,736 minus 49,674, and that will be the amount presumably. Let's back that up. Take 496,736 and you would add the 49,674 because you haven't paid it yet. So you would add that to the principal and you would multiply that total times 10% to get the 2018 amount. Now at the end of the year, there's also 136,602 increase in the retirement obligation, the ARO, and so the ARO goes up. The liability, ARO liability, goes up by 136,602. Under IFRS, that gets put into the cost of the inventory. So presumably you've got oil in inventory. That cost of oil, or cost of goods sold, presumably if you've sold it, would be recorded at 136,602. And the drilling platform itself would be increased in cost under ASPE. And then when you finally settled everything up at the end, presumably you've got an asset retirement obligation of $1 million because you've been increasing it every year through the accretion. And the fact that we only paid $995,000 in cash means that we've got a slight gain on the settlement of the ARO. And so the ARO goes away because we've done everything we're supposed to do. And cash paid was $995. The difference is going to be a gain. Could also be a loss, but in this case it's a gain. Okay, reporting and disclosure requirements we should talk about briefly. Most of the AROs are long-term in nature, and so they're not going to be part of current liabilities. So some of this discussion is for a later chapter, but because of the increase, the annual increase in the amount of the accretion of the discount, we've talked about it here as part of our current liabilities. Okay, unearned revenue. A company that receives cash in advance, so they've promised to perform services or give sell a product in the future. They receive money in advance. When that cash is received before the product or service is rendered, then we set up unearned revenue. The classic example of WestJet tickets paid in advance. So these transactions result in a credit to a deferred account, and it's a current liability in most cases if we're going to settle the obligation within the next year. And when we actually redeem the claim, then we get rid of the unearned revenue and record the actual revenue. So that one we've dealt with lots of times in the past, so nothing new there. Product guarantees and warranties. Now businesses often promise to pay continuing warranty obligations to a customer, so they make sure that if something happens to your product, they're going to replace it or fix it for you. And that obligation can arise in a number of different ways. There's generally two approaches. There's a service type warranty, where you sort of buy the warranty separately, or there's the assurance type warranty, which is included as part of the cost of purchasing the asset. So kind of if the warranty is included, it would be an assurance type warranty. Now, historically, we used an expense approach where we set up warranty expense to match against the revenue this period, and we set up a future obligation. And that type of approach is still the one we use for assurance type warranties, which are sort of packaged as part of the cost of the asset, part of the revenue of the asset. But the more recent standards have distinguished between that and the service type warranty, and so they're using a revenue approach for warranties that aren't included in the sales price of the product. So you set up the revenue for the service type warranty and then offset that as you pay the expenses in the future. We'll talk about how that works with an example here in a second. So an assurance type warranty, when the warranty is part of the sales price under IFRS section 15, the outstanding liability is measured at the cost of the economic resources that are needed to meet the obligation. So whatever the cost is going to be, we set up the liability, and it's an assurance type warranty, so we use an expense-based approach, and it assumes that along with the liability that we recognize at the reporting date, the balance sheet date, the associated expense needs to be measured and matched with the revenues of the period. So in fact, the need to match expenses is the key issue there. So it's a matching concept that's really in view there. As the actual costs are incurred, we reduce the liability because we've paid off our obligation. And so that type of approach is still being used under ASPE for both kinds of obligation. Now, under a service type warranty, IFRS 15 says when the warranty is sold as a separate service, so you've got the you buy the asset and then they say, would you like to buy a warranty? That separate warranty that you're paying for has a separate revenue amount. And so in that case, the outstanding liability is measured at the value of the obligation that you have, and it's kind of the output price. So it's based on the revenue that you're earning. It's an output price rather than input price or cost measure. It's not the cost of doing the service, it's the price that you sold it for. So when assets are received in advance for a variety of performance obligations to be delivered in the future, basically you're receiving cash now for an obligation that you're going to have to deliver in the future. So this is a service type warranty. We use a revenue-based approach. The proceeds are basically unearned revenue at the point of the sale. So you set up unearned revenue, and then as time passes, you no longer have the obligation for the first year after 1 year has passed. So you would recognize the revenue for that period. You no longer have an obligation to deliver it. If there are any actual expenses during that period, of course, you record them as expenses and then match it to the revenue which you've taken out of unearned revenue and put into revenue over the period. So we talked in Chapter 6 of the textbook in 353, we talked about a contract-based approach to revenue recognition. That's really what we're talking about here. We're talking about the contract that sets up the revenue. So we earn the revenue over time, and we record the expense as it occurs during the period of the revenue recognition. So the liability represents a performance obligation for the warranty. The revenue is recognized when the service is provided, and usually it's a time. It's related to the amount of time that's passed. So the performance obligation is satisfied when you've fulfilled the warranty for a full year. Under ASPE, this approach can be used if you can separate out the cost of the service type warranty from the goods or services. You record the revenue for the goods and services, and then record separately the revenue for the service, the warranty service over time. So the big differences between these two different approaches: under the expense approach, the liability is measured by estimation in advance. So you estimate the cost of meeting the obligation in the future. Under the revenue approach, the liability is measured at the value of the service to be provided, not at its cost. So essentially it's the revenue that's earned over time. So you set up the liability as an unearned revenue, and then as the obligation time period passes, you recognize it as revenue. Under the expense approach, assuming the estimate of the future cost of the obligation is close to the actual future cost, there's really no effect on future income. You've recorded everything this period, so you've sold the asset this period, you've got the warranty expense recorded this period, there's no future income effects. Whereas under the service type warranty, under the revenue approach, revenue is recognized in the future. You don't get to advance the recording of the revenue this period and then match the expense against it. So service type approach, record the revenue from the warranty sale, you defer it as unearned revenue, and then over the life of the warranty, you get the unearned revenue becomes earned revenue, and any costs that you incur are matched in the same period. So here's an example. We sold some equipment January the 2nd. The sale price of the equipment is $20,000. The standalone value of the 2-year warranty, if you bought it separately from the equipment, it was $1,200. So included in the $20,000 presumably is $1,200 of warranty costs. So the costs of $423 were actually incurred in 2017 to service the warranty. So the journal entries are like this. We get cash of $20,000. $18,800 of that is sales revenue for selling the equipment. And then we've got a $1,200 future obligation, unearned warranty revenue for the remainder, the $1,200. After the first year is passed, we record a reduction in the unearned warranty revenue, debit $600, and record an increase in the warranty revenue, which we've earned as $600. And it's just a straight line obligation because there's no difference between the expected timing of the warranty. So straight line is applied in this case. There is a little note here that says, that says that recognized over the life of the warranty in the same pattern as the costs are expected to be incurred. So if there's expected to be an even amount of warranty expenditures over the next 2 years, we would use straight line. If for some reason there's a higher expectation of warranty expenditures in the second year, we might use 1 out of 3 the first year and then 2 out of 3 the next year, something like that. So warranty expenses, we actually paid $423. It cost us cash, $423 or parts or whatever. And so we have matched the warranty revenue of $600 against the cost of the warranty expense over time. So we're not matching it in advance, we're actually matching it as we earn the revenue. An assurance type approach, it says if we can't actually separate out the warranty from the sale price of the asset, then we would use the more traditional expense-based approach where we set up an estimate of the future expense now in order to match against the revenue now. So a warranty is promised by the seller to make good on any deficiency in the product, and so they're obligations that we are promising to pay a future obligation. So once again, it's an obligation that we can't get out of. It's based on a past transaction, so they've already bought the warranty. That's happened in the past, and say future, it represents an obligation to pay in the future. We haven't actually done the warranty obligation yet, so it does represent the definition of a liability. IFRS 15 is the appropriate standard. It's clear about when the expense report should be used. The expense approach should be used for assurance type warranties. The revenue approach should be used for service type warranties. Under ASPE, the principle is that revenue that covers a bundled group, if you can, you should unbundle it and separate the warranty from the revenue that you've earned from selling the product or service. If you can't do that, then you would use the expense approach. Okay. So here's an assurance type example. So the assurance type example is the one we talked about before, where we set up the expense to match against revenue, which is already earned. So let's imagine that the warranty is included in the cost of the units that we've sold. So we've sold 100 units at $5,000. That's $500,000. The average repair cost is $200 per unit, so that's $20,000. 200 times 100. We've got total warranty expenses of $20,000. The actual repair cost that was incurred in 2017 was $4,000, and so they use a calendar year as the fiscal year, so December 31st year end. Their further warranty costs in 2018 are estimated to be $16,000. So let's record the warranty expense under that assumption. At the time of the sale, you would make the you would recognize the warranty obligation at the balance sheet date. So the actual warranty costs at the during the year, we actually spent $4,000 to cover our warranty expenses, so we set that up as a warranty expense. And then at the balance sheet date, we assess our warranty liability in the future. Turns out there's $16,000 that we still owe, so we would set up an expense at that time to match against the revenue which you've already recorded. The $500,000 in revenue this period includes payment of that obligation in the future. So the difference between the service and assurance approaches, the service approach says that we recognize revenue over time. So we recognize the revenue as unearned revenue, and then as we actually earn the revenue over time, the value of the service is recorded as revenue. It basically delays revenue. It's a more conservative approach, but it records the expenses at the time that we actually pay the expenses, and so they're implicitly matched against the revenue in that way. Under the expense approach, we set up a liability at the beginning. We have to estimate it in the future, which is a much more difficult measurement approach, but we don't have any way of measuring the revenue that we're getting in the future associated with the warranty, so we record it up in advance. Under the expense approach, everything happens at the time that you make the sale, so there's no effect on future income. Under the revenue approach, we record revenue out of unearned revenue over time, and record the expense as the obligation is actually delivered. Okay, so that's enough about warranties. There are some other kinds of promises to provide future benefits for our customers. So I'm jumping ahead of myself here. Okay, I think we talked about those things. The one key difference that you need to recognize is, for accounting purposes, you use either the expense approach or the revenue approach. And warranty costs, if you're using a cash basis, you actually record warranty costs when you're actually paying the costs. That is required for income tax purpose. In general, income tax purposes, the Income Tax Act says that you can only record an expense when you've paid cash for it. So you can't actually set up a future law obligation or record expenses in advance of when you actually pay them. Okay. All right, moving along then, customer loyalty programs, which I began to talk about. So customer loyalty programs, these can include premiums or coupons or rebates or other kinds of loyalty programs. A lot of companies offer premiums or other benefits to customers in return for, used to cut off the box tops of your cereal and be able to submit that for, secret decoder rings, those sorts of things back in the day. So box tops, coupons, labels, wrappers, some other evidence of having purchased a particular product gives you the right to collect a certain promise in the future. So you could get silverware, dishes, or small appliances. There's lots of different programs that they've had in the past. Or you could just get simple, cash values, which you could use against future purchases. Lots of different ways that these things are set up, and marketers are infinitely creative. And so we need to account for them as accountants because they do represent an obligation that we have to deliver a service in the future. So it's something based on a past transaction because our customers already bought it. It's an obligation we can't get out of because we're promising to fulfill the loyalty program in the future. And it's based on, we're going to have to settle in the future for a past transaction which has already occurred. So, for example, printed coupons. If you've got printed coupons that can be redeemed for a cash discount on an item that's commonly used as a marketing tool, or a cash rebate, which you can, after you buy it, you can send in your proof that you purchased it, and they'll send you either a cash payment or some additional warranty coverage or something in the future. How do we actually account for that future obligation, which is the question here. So contests, another example. The life of the contest might run a few months, and the coupon, the coupons could be 6 months into the future. Companies have to figure out how to account for this marketing nightmare. So the marketing works quite well, but the accountants then have to figure out how they affect the future obligations. And they could affect more than one fiscal period. So at the end of this period, we might have to account for the fact that we've got these outstanding contest winnings or rebates or coupons. How do we account for that? So historically, we've tried to make an estimate under the expense approach, similar to a warranty. We've set up an obligation today, matching the expense against the revenue. But that, IFRS is changing the way they approach that, and they're trying to make it as much as possible similar to what we call the revenue approach for warranties. So some of the changes affect these customer loyalty programs as well. So the accounting issue is that when these promotions increase current sales revenue, the associated costs are going to be incurred in future periods, and so the matching concept says we should deduct the total estimated costs against the current period's revenue and match the expense against the revenue. So set up some kind of a premium or promotion expense this period to recognize the fact that we have to settle up in the future for the obligation which we've created today. So the obligations existing at the date of the balance sheet, the statement of financial position, has to be recognized and reported as a liability. It could be called something like estimated liability for premiums or estimated liabilities for coupons, those sorts of things. Those sorts of titles might be used. Now, customer loyalty programs where customer loyalty credits are awarded are considered revenue arrangements with multiple deliverables. So customer loyalty programs, basically you buy a certain number of frequent flyer miles might be the easiest one. So you accumulate all these air miles over time by buying lots of products, and then you've got some future obligation which you can collect on. You can get free travel or whatever in the future. How do we account for those sorts of things? So the initial attempt for IFRS was to use the interpretation 13 customer loyalty programs, which is going to be superseded by the new IFRS 15 when it's issued. So the revenue from the original transaction is supposed to be allocated between the award credits and the other components of the sale. The fair value of the award credits recognized as unearned revenue in a liability account, so the future travel that you could get or the future payment that you could get, that gets set up as unearned revenue, and then you would recognize the revenue as you actually deliver on your obligation. So you recognize the revenue when the credits are exchanged for those promised awards in the future. ASPE doesn't really address the issue. It does reflect the general principle that revenue recognition criteria should be applied if you can identify separately the components of the single transaction to reflect the substance of the transaction. So they don't have a specific standard on loyalty programs, but essentially you're looking at recognition of revenue. So can you measure it? Is it collectible? And is it, what's the other C? Completed when you've actually delivered the goods. So if it's just a marketing expense, you may actually record it as a marketing expense this period. So if you can actually estimate the future, the cost of all of the delivery, you may just treat it as a marketing expense this period. So if the cost is really a marketing expense, just a way of getting your name out there and getting it recognized, then you could treat it as a marketing expense. So if the costs associated with premiums and rebates are really marketing expenses, the expense approach would be a reasonable way to account for them. So on the other hand, IFRS 15 and the predecessors to IFRS 15 suggest it's more appropriate to use the revenue approach. So figure out what it is that, what the related revenue is. So you set up the value of the future premium, whatever the payment of the future award is going to be, and record it as unearned revenue until such time as the request is actually made. And then whatever the expenses are would get matched against that revenue over time. So you would allocate some of the consideration from the sales transaction to an unearned revenue account, and then as time passed, you would recognize the fact that you have actually earned the revenue. Okay, finally, we're getting down to the end here. Contingencies and uncertainties. Contingencies and uncertain commitments. Now, the definition of a contingency is an existing condition or situation involving uncertainty as to possible gain or loss to an enterprise that will ultimately be resolved when one or more future events occur or fail to occur. So it's something that depends on a future event. There's uncertainty today with regard to the possible outcome. It could be a gain or it could be a loss. An existing situation involving uncertainty as a possible gain or a loss to an enterprise that will ultimately be resolved when or more future events occur or fail to occur. So resolution of the uncertainty may confirm that we've got an asset. So if we're suing somebody and we win, then they owe us money. That's an asset. Or the reduction of a liability. They say we owe them $100,000 and we sue them and say, no, we only owe you $10,000. If there's a reduction in the liability, that's also resolution of the uncertainty about the value of the liability. So contingent gains and contingent assets are not recorded in the accounts. We talked about that when we talked about these issues in 353. They're not recorded in the accounts. And so essentially the key things we talked about with regard to contingent gains and assets are related to the degree of uncertainty, and we basically made note disclosure if it was probable that we would get a future benefit. Now, the liability side is different, though. We wouldn't recognize gains or assets until we actually receive, confirmation that we're actually owed the amount. But on the liability side, we do recognize the liability in advance under certain conditions. Once again, conservatism or prudence represents the fact that we need to record the liability when it becomes due. So slightly different terminology between ASPE and IFRS. Under ASPE, we talk about a contingent liability, and we have sort of three different levels of probability: the likelihood of the occurrence of the future event. So if it's likely, there's a high chance; unlikely, a very low chance. Or if we can't determine the chance of a future event, so think about a lawsuit. We've sued, somebody has sued us in this case because it's a liability. Either it's likely that we could lose, it's unlikely we would lose, or not determinable. We would ask the lawyer to make an assessment on the likelihood there, and then we would record the liability. So estimated losses are accrued. That means we record the liability if both of the following conditions are met. It's likely that a future event will confirm a liability has been incurred, and we can reasonably estimate the amount of the loss. And that's the historical contingent liability requirement. So if it's likely, that means it's more than 50% probability, and we can estimate the amount of the loss. If we can do both of those things, we would actually record the loss as a liability. So it's an obligation to pay the amount of the lawsuit. We would add additional information in the notes if it's not likely that a future event will happen. If it's unlikely, then we wouldn't record the loss at all. If it's not determinable, or if we couldn't reasonably estimate the amount of the loss, we would just record in a note that the obligation exists. So if the likelihood is not determinable, we would record in a note saying that we've been sued and we can't determine the likelihood of losing the suit, or that a reasonable estimate can't be established. Now, to the extent that we can establish a reasonable estimate, so we can say that it's it's going to be more than $100,000, but we don't know whether it's going to be $100,000 or $200,000, we would actually accrue the loss for the $100,000, and we would disclose in a note the extra $100,000 that we weren't sure was going to be paid. So we may actually have a situation where part of it is recorded as an obligation and part of it is recorded as a note. Okay. Now, under IFRS, the rules are slightly different. Under IFRS, Estimated losses. Under current IFRS rules, provisions are required for situations such as lawsuits, where it's more likely than not that a present obligation exists. So that's more than a 50% probability. Because it's more likely than not that the company will lose, these are considered liabilities. And so they're actual liabilities, they're not contingent liabilities. They're considered liabilities of the company under IFRS, and so we would set up a provision. Now, provisions aren't required for contingent liabilities under IFRS because they're defined as possible obligations. They're not actual obligations, but if it's more likely than not, then we do have an actual obligation which exists. So, so the recognition criterion used to determine if a provision should be recognized is based on whether it is probable that there will be an outflow of future resources or outflow of resources in the future. Probably is interpreted to mean more likely than not, which means more than 50% probability. It's a somewhat lower hurdle than the likely required under ASPE. Likely in ASPE means you've got a high likelihood of it happening. So it's the probably means more than 50%, more likely than not, whereas likely has some higher measure of probability in mind. If the amount cannot be measured reliably, then the amount would be considered a contingent liability, and we wouldn't recognize the liability under IFRS either. But if we do recognize it, IAS 37 says that the best estimated and expected value method is to be used to measure the liability. The expected value assigns weights to the possible outcomes according to their associated probabilities if a range of possible amounts is available. Unless the likelihood of needing future resources to settle a contingent liability is remote, disclosures are required about the nature of these uncertain amounts, and if practicable, an estimate of the financial effect, information about the uncertainties related to the amount or timing of the cash flows, and whether any reimbursements are possible. So, using terms like likely or probability, or using terms like likely or probable to determine accounting for contingencies and provisions involves a lot of judgment and a lot of subjectivity. We usually have to ask the lawyers. So there's a lot of vagueness about the application of the contingent liability rules. So you need to develop a great deal of experience or ask a lawyer to give you some additional information. Litigations, claims, and assessments. So specifically in terms of when you're being sued or suing someone. These are the most common types of loss contingencies that we talk about. So when we're talking about contingencies, we usually talk about lawsuits. And so companies generally only report one current and one non-current amount for provisions in their statement of financial position. And so IFRS requires a lot of extra disclosure related to provisions in the notes to the financial statements. And so when a company is threatened by legal action, such as litigations, claims, and assessments, the recording of the liability depends on a certain list of factors. Among the more prevalent are the time period in which the underlying cause for action occurred. So the cause for the litigation must have occurred on or before the date of the financial statements. So it happens before the balance sheet, not after the balance sheet. The probability of an unfavorable outcome, or the likelihood of an unfavorable outcome, and the ability to make a reasonable estimate. So even if the evidence doesn't favor the company, it's not likely to publish a dollar estimate of the probable negative outcome. That would weaken their position, so you wouldn't actually disclose in your notes that you're going to lose the lawsuit or you might lose this amount, because it could become a self-fulfilling prophecy. Easy for me to say. So how would you actually determine the likelihood of the unfavorable outcome? Well, you definitely talk to your lawyer. So you look at the nature of the case, as it says, the nature of the litigation, and the what's happening in the case. Is it going well for you, or is it going against you? What does your lawyer say? When we do an audit, we actually send a letter to the lawyer asking specifically for their opinion about any outstanding legal action, and so that would be part of the standard legal letter. Your experience in similar cases, if there have been similar cases, your experience as the accountant, your experience as the auditor, your experience, or your lawyer's experience, I suppose, and how the company feels about the lawsuit. Do they think that there's any validity in it? Do they admit that they're wrong? There are a number of things that you can use to assess the likelihood of the unfavorable outcome. But it takes a lot of judgment to do that, and it's very difficult to determine. And of course, you're recording a liability on your financial statements. You need to make sure that you disclose that risk for the readers of your financial statements. Okay, moving along, financial guarantees. Now, financial guarantees, when you read that term, basically you're guaranteeing somebody else's loan. So Solomon has a lot to say about these, of course, in the Bible. The King James Version term is surety. You shouldn't be a surety for someone else, and Solomon definitely advised strongly against doing that. If you sign a personal guarantee, you should recognize that it's really your debt. Even if somebody else is making the payments, you have the obligation. So one of my sons bought a car and didn't have a credit rating because it was his first time buying something that big, and so I signed a document guaranteeing his loan payments. So he's making the loan payments. It's interesting that actually shows up on his credit report, and it shows up on my credit report, even though it's only one debt obligation. We both have it showing up on our credit report. He's just about done paying for it, which I'm really happy about. But if he hadn't, I would have to get paid, or I would have to make the payments for him. And so I agreed with the lender that all of the documentation that they sent him, any information that they sent to him would need to be sent to me as well, because it's really my debt. Not generally a good idea, but there are some reasons you would do that. Solomon advises strongly against it, but businesses do this upon occasion, especially if they're part of a related group, or if it's a holding company that guarantees the obligation for another operating company. It would be a fairly standard situation. And of course, we're dealing with the issue of current liabilities here. Financial guarantees are commonly those where one entity, the guarantor, contracts that it will pay the holder of a debt if another entity, the debtor, fails to meet its obligations. The financial guarantees do meet the definition of a financial liability, and so ASPE requires treatment for the financial guarantees that are similar to loss contingencies, the same kinds of assessments of likelihood and measurability. But under IFRS, the guarantee is recognized initially at the fair value, whatever the premium that is charged by the guarantor, if there's actually a market with a price somehow to guarantee the payment. That would be the amount that was recorded. So under IFRS, the guarantees recognized initially at fair value, subsequently at the higher of the best estimate of the payments that would be needed to settle the obligation at the reporting date. And any unamortized premium received as a fee for the guarantor would be recorded as unearned revenue and recorded as the obligation time period passed. So the key idea here is you want to disclose information so that the readers of the financial statements would know about the risks that you're assuming on behalf of someone else. Commitments. Commitments are when you're promising to transact future transactions at a specific set of terms. Sometimes if you're promising to pay to sell us a product at a certain price, you could actually put yourself in a position where you're creating a loss selling at that level. So these kinds of executory contracts that agree on what the prices or terms are going to be of future transactions. They're called executory contracts because they refer to the fact that you're planning to let me try again. Executory contracts are contracts where neither party has yet performed the obligation, and so they're not included in the definition of a non-financial liability, but they do have a future obligation in mind. So those contractual obligations or commitments arise as a result of agreements. They can be with customers or suppliers or employees. There's lots of other parties that you would enter into this kind of future promise, like a forward kind of contract. Disclosure is required of any significant commitments, especially those that would involve significant future resources or are abnormal relative to the company's usual operations or industry operations or their financial position, or anything that involves significant risk. So even though they don't meet the definition of a liability yet, they do commit the company to a risky position in the future, and so that risk would need to be disclosed. Other issues of presentation and disclosure for current liabilities. The major classes of liabilities should be disclosed separately. So bank loans should be separated from trade creditors, and accrued liabilities like your vacation payable and your employee obligations would be treated separately. Taxes, dividends, deferred revenue, a lot of different categories. They need to be disclosed separately because they represent different risk structures. So current liabilities are usually recorded and reported in the financial statements at their maturity value. Present value techniques are not normally used in measuring current liabilities because the immateriality of the interest impact. Current liabilities are normally listed at the beginning of the liabilities. The shareholders' equity section shows up the beginning of the liabilities and shareholders' equity section. And so in the current liability section, we usually order them in terms of the order of maturity, or we could list them in the order of the amount or in order of the liquidation preference, so which of them ranks first in payment preference. So there's a number of different ways that we actually see them disclosed, whereas on the asset side, we rank them in terms of liquidity. That doesn't really apply here. We can recognize the fact that there's a certain order in bankruptcy transactions or liquidation transactions, so the ones that get paid first might be shown first, but there's no standard order of treatment here. Entities need to disclose enough information about their current liability so the readers can understand and identify the current needs for payments of cash. So what are your current obligations? Let me step back for just a second. Contingencies, guarantees, and commitments we've talked about. The disclosure there, you disclose information about contingencies, guarantees, and commitments if it's likely that a future event will confirm the existence of a loss, but you can't reasonably estimate the loss, or if a loss has been recognized, but there's an additional exposure to an additional loss that is higher than the amount that was recorded. If it's not possible to determine the likelihood of there being a future event that confirms the liability, all of those arise out of the definition of the contingent liability part. If any of those three things are true, then you would disclose information about those future commitments. Companies reporting under ASPE are required to report contractual commitments that are significant relative to their current financial position. So if you've entered into a long-term contract to sell at a specific amount and you could actually end up in a loss position, you need to disclose that information. Under IFRS, companies are required to disclose a brief description for each class of contingent liability unless the probability of outflow is remote. And they're also encouraged to disclose an estimate of the financial effect of the liability. Disclosure information needs to be sufficient to meet the requirement of full disclosure, so companies should clearly identify secured liabilities. Secured liabilities are ones which have specific assets encumbered by the liability, and as well as indicate the related assets which are pledged as collateral. If the due date of any liability can be extended into the future, a company should disclose those details as well. And companies shouldn't offset current liabilities against assets that will apply to their liquidation. You need to show the full amount of the liability and the full amount of the assets as well. And current maturities of long-term debt should be classified as current liabilities. So the current portion of your mortgage obligation should be shown as a current liability. Analysis. We have a few ratios that are important. So the current ratio, the relationship between current assets and current liabilities, that should be substantially more than 1, which means that you could pay your current liabilities out of your current assets. Your inventory assets would be included there. So inventory takes a little while to sell and recover cash. So that number would have to be something more than 1. The asset test ratio looks at cash, marketable securities, and receivables. So it's like current assets without prepaid expenses and inventory, those sorts of things. Take that as a percentage of current liabilities. That number should be 1 or more. So this is if you had to pay your obligations today, you've already got cash. You could sell the marketable securities. You could probably sell your receivables fairly quickly to somebody who buys receivables on a regular basis. So you could get cash for all those sorts of things. So if you had to pay your bills today, how much could you pay? Usually you would like that number to be around 1 or slightly more than 1. Days payables outstanding. So this is how long your payables are outstanding. So if you take your average trade accounts payable and divide by the average daily cost of goods sold, that would tell you, the number of days outstanding, so the percentage of a year. So your accounts payable balance divided by your daily cost of goods sold is the percentage of a year of cost of goods sold, which is represented in your trade accounts payable balance. So normally we do it the other way around, right? You'd calculate cost of goods sold divided by your average trade accounts payable, and that would be your turnover. And then you would take 365 and divide by the turnover, and that would give you your days payables outstanding. Okay, looking ahead, a couple of things to think about. Look at text illustration 13-15 if you want a little bit more information to describe the difference between IFRS and ASPE in regard to the things we talked about in this chapter. ISB, the International Accounting Standards Board, issued an exposure draft in May 2015 talking about the conceptual framework for financial reporting, and that includes things like the definition of liabilities, definition of assets, those sorts of things. And the idea of the conceptual framework is they're trying to provide clearer definition of assets and liabilities, and give a little bit more definition, more detailed guidance to interpreting those definitions in specific situations. In 2010, they issued an exposure draft with proposed amendments to IAS 37, which is provisions, contingent liabilities, and contingent assets. They wanted to remove the term contingent liabilities, but in July 2015, staff papers was published that said they're looking at that again. So we don't have a new IAS 37 at this point. So definition of liability, the application of recognition criteria are expected to change in the future. That's it for PowerPoint 13. We'll see you in class. Thanks, bye.